Hi, in this short video, we're going to talk about India's GDP numbers and what India needs to do at this point of time to kind of create an uptick in the GDP numbers as we see. We know that the GDP calculations can be done by three methods. You could either measure the entire output of the country, you could either measure the entire final consumption of the country, or you could measure the cumulative income of every person in the country. Now, GDP, the most intuitive and commonly used method is the consumption or expenditure method, where you basically find out who's consuming or expending, creating expenditure in the economy. Uh, if there is any consumption that's happening in the economy, there are broadly three entities that can do it. Either the government does it, or the consumer does it, or businesses do it. Then there are some items that are produced in the country but not sold in the country, so that's exports. There are some items which have already been sold in the country but were never produced in the country, so you need to subtract those. That's imports. Right now, by the analysis of the individual components of this equation, we can try and identify what are the near-term steps that someone has to take in order to ensure that GDP growth kind of revives in India. Right. So at this point of time, we're around $2.7 trillion as per estimates. And this keeps changing a little bit because the rupee dollar rate keeps changing a little bit. In the next year or so, we should be the fifth largest economy of the world after US, China, Japan, and Germany. But it's the growth rate that we are worried about. If the GDP has to grow, one of these components has to be the primary mechanism of making that growth happen. Right. So let's analyze these components one by one and see what's happening. Let's analyze this chart, which plots the quarter-wise growth rate in consumption and investment over the data that has been given to us over the last many quarters. You will very clearly see the red line, and the red trend line is the sort of a growth trend in consumption, and that seems to be slowing down. Also evident from a lot of other anecdotal data around us, like auto sales or real estate sales or cement sales, etc. You would also want to see what's happening with investment cycle. That is growing from a lower base in terms of a smaller growth number and seems to be a trending upwards. But a sustainable growth in investment is only going to happen if consumption revives, because businesses are already sitting on overcapacity. So unless you see a consumption revival happening, very difficult for a company to go and put capacity. When you read news like Ashok Leyland and Maruti are shutting down their plants for a few days, it's very unlikely that even if you cut interest rates, they're going to go and put more capacity or put investments in the business, right? Investments as a percentage of your total GDP, this graph plots that. So it used to be 36.7% in FY12 as per the data released, fell all the way down to 29% in FY17, has improved marginally from there, but is still nowhere close to what it used to be as a component of GDP. So very clearly, the growth that has been coming primarily on account of consumption being a major chunk of your GDP. We have had this big consumption fueled growth because of credit, because of private consumption that has played out. And it seems that is slowing down at this point of time. And that could just be a lull after a 10-15 year of good growth, right? Now, if that is happening, then consumption is kind of going to be difficult to revive your GDP, or at least that's growth slowing down. So it will pull the GDP growth down. Investment is not going to pick up by itself unless consumption demand is kind of visible. What's happening with exports minus imports? Now, this is only merchandise, goods, export and import data for us. This is not services. Services is a slight positive number for us. This number is a negative number. Minus $183 billion was what our deficit was on goods, exports and imports in FY12. It fell down to 109 because crude prices or oil imports fell a lot between that period. But once crude prices started going up again, at the end of the last year, we were again almost at the same level as we were in FY12. So X minus M is unlikely to be the engine of growth in terms of our GDP as well. Also because just as much we want to export more, for us to export more, someone has to be importing our stuff, and that doesn't happen overnight, right? So within this equation, X minus M probably is not going to take us out in the near term. Consumption seems to be slowing down. Investment is unlikely to revive, which means if GDP has to go up, the government has to be the key driving factor there. The government has to push its expenditure. The government has to essentially create fiscal policies which are good for growth, which might mean cutting taxes as well. But the government is stuck in a sort of a dilemma on whether they should control what's happening with the fiscal deficit, or they should kind of go full throttle on the growth in the economy. And so that is the decision that we face. Unless the government pushes this further, unless the government is the catalyst of investment growth or infrastructure growth or spending in the economy, it's going to be a little bit difficult for us to revive GDP in the immediate term. Of course, markets have a self-correcting mechanism, so over a period of time, consumption and investment will pick up. That's undoubtedly going to be true for a country like India. But if you want to revive GDP growth in the immediate near term, the government has to play a reasonably large role there. And that's what brings us to a question at the end, which is, do you think the government should leave the fiscal deficit target for a couple of years and push it in terms of higher growth in the near term, or the government should kind of be disciplined and keep the fiscal deficit target? Would love to hear your thoughts on this. That's where we end this video. Another video where we'll discuss the fiscal deficit data, but would love to hear your thoughts on that before that.